Hi guys, welcome back to Father and Son Investing. As we wrap up the year, many of you like me have been looking to see how your performance has gone for the year compared to the standard, which is generally the S&P 500 index. I can tell you that my results have not been as great as the index, and I'm guessing that many of you, or most of you, are just like me. Today we're going to talk about 4 funds that we can use to improve our investing for 2022. But before we do that, I want to take you back to 2006. 2006 was before the financial crisis, but a lot of the things that set that up were already in process. In 2006, at the annual Berkshire Hathaway meeting, somebody asked Warren Buffett about hedge funds. Essentially, he said that hedge funds are not worth the money that they get paid, and he said that he could pick something that would beat hedge funds over 10 years. Well, it took until 2008 for somebody to actually take that bet. I'm going to play you some excerpts from a Planet Money podcast where they detail how this bet went down. To do that, I'm going to play you a clip first discussing index funds and Jack Bogle. Jack Bogle, of course, is the famous founder of Vanguard funds. Listen to this.
And you invest, say, $10,000, they're going to charge you a fee of $100 every year.
The Vanguard Index Fund, they're going to charge you $5.
In recent years, a lot of people have said, okay, I give up. A bunch of money has flowed into index funds.
We wanted to see what giving up looks like, so we went to the room where they run their index funds. And, it wasn't much, it was quiet. There were a few computers. Could have been like any office. There's a handful of people in there, and they're very intentionally not picking stocks.
It does seem boring. It does feel like giving up.
It is the essence of boredom. I'll concede it. If you're in investing for excitement, you are a damn fool. You're watching the market every day, up and down, 100 point, 200, 300, 400 point swings day after day. It's exciting, but it's meaningless.
All right, boring. That's how Jack Bogle describes it. But that boring index fund makes a lot of people a lot of money. And so in 2008, when it came time for Warren Buffett to pick something that could beat the hedge funds, what did he pick?
So that is the story of the boring, super simple investment that Warren Buffett picked for his side of the bet.
And to be clear, he actually picked that very fund, the Vanguard S&P 500 Index Fund.
All right, who actually took the bet? His name was Ted Saides. He decided that he would pick a number of hedge funds to compete against Warren Buffett and his S&P 500 Index Fund.
Now for someone from the other side of the bet, the humans can win, we can do better side of the bet.
His name is Ted Saides. He's worked for years in the hedge fund world. He heard Warren Buffett's challenge and figured, yeah, I know some really smart people who can do better than average.
I thought I had a rare chance to catch somebody like Warren potentially being the patsy at the poker table.
I'm sorry, you said to catch him being what?
The patsy at the poker table.
This is the summer of 2007, and Saides sends Buffett a letter, like an actual letter, in an envelope with a stamp, old school. He says he's interested in taking the other side of the bet.
And so let's talk about what stakes you propose. And my typical stakes might be over dinner. Yours might be a little higher than mine, but let's see what happens.
A little while after that, Saides gets this email, and there's a PDF attached. He opens up the PDF, and what's happened is Buffett has taken that letter and just scrawled some notes on it. And then somebody scans it in and sends it back to him. So they go back and forth for a while now. They start negotiating the bet.
Safe to say he was comfortable with higher stakes than I was.
You're making a bet with one of the 2 or 3 richest men in the world.
Correct.
They settled on that $1 million bet. Buffett picked the Vanguard S&P 500 Index Fund. Saides and his partners picked a collection of hedge funds.
So remember I said that this bet started in 2008. That, of course, was a terrible year. That was the year of the financial crisis. What happened?
The first year, 2008, was a terrible year for Warren Buffett, a terrible year for the index fund. As you probably remember, that was the year of the financial crisis. The stock market, the index fund, got hammered.
Yeah, Buffett had terrible timing, right? Worst time to start this bet. By early 2009, things were looking really good for the hedge fund side, for Ted Saides.
We were way ahead.
Like what to what?
The market would have been down about 45%, and the hedge funds were probably down about 25%.
So if I'm imagining 2 runners on the track, like your runner is really kind of pulling ahead at this point.
It's safe to say our runner hadn't moved much and the market runner had gone backwards.
All right, so you're probably wondering, how did this bet turn out? Well, here are the numbers. That first year, 2008, of course, the S&P 500 did way worse. But then in a number of other years, we see that the S&P 500 index fund just continues to beat the hedge funds. And when we look at it by the numbers here, there were actually 5 different hedge funds that Ted Saidi's picked. One of them came semi-close, 62.8% up at the end of the bet, but the S&P 500 was up 85.4% by the end of the bet. All right, I mentioned that I haven't done as well as the S&P 500. Before you here is just an example of what I have available to me in my 401k. Now, the orange line is the S&P 500 since December of 2020, and the blue line is my picks in my 401k. You can see that I'm running behind. So what exactly do I have in my 401k? Well, initially I started out trying to pick a bunch of funds that I thought were going to beat the S&P 500, and I would be willing to pay a little bit more in fees for that. And I discovered that that wasn't doing so great. So what have I done now? I've turned my investing over to Vanguard index funds that are available within my 401k. The point I'm trying to make here is that oftentimes we think that we can outperform the market, or we can use our intelligence to pick things that will do better than what the market will do. Now, we started with the 2006 Berkshire Hathaway annual meeting. I want to take you to some excerpts from the 2021 Berkshire Hathaway meeting, where Warren Buffett discussed something very crucial to today's topic.
Slide L1. So put that up. And on March 31st, I ran off a list of the 20 largest companies in the world.
After going on to discuss the companies that are on that list, Warren Buffett then did this.
And then make an estimate, make your own guess. How many of those companies are going to be on the list 30 years from now?
Now, obviously, nobody knows exactly the answer to that question. But then he did this.
I would now invite you to look at slide 2, or L2, which goes back a little more than 30 years, and look at the top 20.
If you look closely, none of the companies that were on the list today were on that list 30 years ago, and vice versa. All right, so with that in mind, I want to give you 4 potential funds that you could use to improve your returns for 2022, and here they are. Now, to take you through these 4 ETFs that I want to talk about, we're going to use the JP Morgan Asset Management website. So I have here listed several funds here. You'll see that there's actually 6 of them listed there. I just threw in a bond fund for comparison. We're not really going to talk about that. And 2 of these funds, VOO and SPY, are very similar. Those are both market-weighted S&P 500 ETFs. Now, what does that mean, market-weighted? Well, what it means is that it's based on the market capitalization of each company within the S&P 500. So we take, for instance, Apple, we multiply its price times all of the number of shares, and we come up with a valuation for the company, or the market cap. So for instance, at the time of the writing of this article, Apple was the largest one, making up almost 6.7% of the S&P 500 ETF. What does that do? It tends to concentrate large companies, large cap companies, at higher percentages within these 2 ETFs, such that they make up, the top 10 holdings make up about 27% of these 2 ETFs. If we look at the theoretical performance of $10,000 invested in 2015, we'll see that this line here, it's really difficult to separate the S&P 500 index, the SPY ETF, and the VOO ETF, because they tend to mimic each other all along the way. That makes sense. Both of those ETFs are designed to replicate the S&P 500 index, and so their performance is very similar. If we look here, we'll see that they're just slightly different. The Spider SPY is a little less than 25,000, and the VOO is a little more than 25,000. I attribute that just to the difference in the fees that they charge. Not too much else to say about both of these ETFs. Great funds, great companies, which both have very low fees. Now, if you'll notice here, there are two colors on that chart, though, that are far exceeding those two ETFs. And what are these two ETFs that represent those colors? Well, the very top one here is the Vanguard S&P 500 Growth ETF. Let's quickly talk about that. The ticker symbol for it is VOOG. And if you look at the stock style, what you see is that this is concentrated on S&P 500 companies that are growing, so concentrated on growth and concentrated on large cap. If you look at the top 10 holdings, you're going to see a lot of information technology there with some other big companies thrown in. And the top 10 make up almost 54% of this ETF. As far as the different kind of companies that you're going to get, should you choose to invest with this ETF, you're going to get a lot of information technology. Almost 44% of this ETF is information technology. Now, there is one nice thing also about this ETF besides its performance, and that is its cost. Relative to the cost of the S&P 500 indexes, you're going to have to pay a little less. So that's nice if you don't quite have enough money to purchase one share of the S&P 500. For a significant amount less, you can get VOOG. All right, what is the other color represented here? We see this sort of yellow-orangish line, and it is the iShares Exponential Technologies ETF. It states here that they want to invest in global companies that offer significant exposure to exponential technologies, which displace older technologies and create new markets. Now, the nice thing about this one is that it's not very concentrated in any one holding. In fact, you're going to get about 290 companies with this ETF. As of September 2021, the highest percentage was in GenScript Biotech Core, and that made up about 1.1%. And in fact, the top 10 holdings only make up about 8%. However, if we look at the top sectors, again, you're going to be getting a lot of information technology with a healthy dose of healthcare, followed by less than 10% of multiple other sectors. And as far as the geographic breakdown, it's mostly within the United States, almost 60%. And you can see there the other breakdown for the rest of the world. What else are you going to get should you choose to invest using this ETF? You're going to get a pretty significant expense ratio. It's 0.47%. So you'll have to decide for yourself whether that increased expense ratio is going to be worth what has been shown to be, for the last few years, increased performance relative to the S&P 500 ETFs. All right, we're going to wrap up our discussion here with one other ETF, and really it's going to be used to show the difference between market weight ETFs and equal weighted ETFs. We're going to look at this green line. The green line is the Invesco S&P 500 equal weight ETF. So an equal weight ETF makes up its portfolio of stocks equally, meaning that Apple will have roughly the same amount of weight as whatever the 500th company is in the S&P 500. That then puts them all coming in, if you do the math, essentially about 0.2% each. Now, how does that change the sector distribution? Because that really is kind of the key point here, to eliminate some risk from over-investing in one particular sector. If we look here at the market-weighted index, you'll see that information technology is about 25%. And if we go to the equal-weighted index, it brings that down to about 15 to 16%. It also brings some areas up, such as industrials. In the market-weighted, it's about 8%, and it brings it up to about 14% in the equal-weighted index. However, what does that do in terms of your performance? You can see here that the equal-weighted index is significantly underperforming the two S&P 500 indexes. So that's going to wrap up the discussion for these 4 ETFs that may help improve our performance for 2022. Now, before we close, let's just go back to that Warren Buffett bet that I spoke about earlier. I wanted you to hear the concluding remarks from the guy who took his bet, Ted Saides.
Isn't it also possible that it is just very, very hard to beat the market?
It's not possible. That's a truth.
What's your advice to ordinary people who do not have a lot of money but want to put some of the money in the stock market?
I think they should index.
So what we learned out of this video today is that it is boring to invest in index funds, but they provide a higher return. So why then should we as investors be also considering investing in individual companies? Well, I think really it is about financial education. I have learned far more about investing and about companies and about accounting and so many other things by exploring different companies that I'm interested in, and I think that many of you would probably say the same thing. So then how much of our portfolio should we be investing in these index type funds versus the more exciting individual stocks? I personally am going to shoot for about 10 to 15%, and that's roughly where I'm at in terms of my investing. Now, I realize that I'm going to have some big winners in there. I certainly did great with Moderna. I bought it around $40 to $60 a share and sold it off greater than $400 per share. But I also have had plenty of losers and plenty of things that are in the red. But that does not make up anywhere near the majority of my portfolio. Please share this information with a young person in your life. Make investing a family affair. I hope your 2022 investing goes well with these 4 ETFs. And until next time, enjoy your investing.